on self-employment and financial support. Self-employed tend to be a little bit kind of ignored, probably by mainstream benefits advisors for a number of reasons. But they are a really kind of important group who've seen some major changes in the way in which they can access help over the past few years. So it's worth looking at a couple of little things, first of all, about who are the self-employed. Are there a lot of them? What's changing for them? How much do they earn? There's some real issues around that. What used to be the system of help for them, and now how is universal credit, the main one, working with the issues that come in for MIF, the minimum income floor, the variability of earnings, how you determine whether somebody, for benefit purposes, is self-employed, what happens if they make losses, how do you handle their expenses, and what happens if they make more money than they are expecting to, what's called a surplus earnings area, and the way in which they have to report their earnings now for universal credit. So kicking off with who are the self-employed, and I'm going to use a 2016 report simply because that's the one that has most of the detail and gives us an idea of some of the trends, but there are some more up-to-date figures a little bit as we go on through it. Looking at 2016, so really sort of 5-6 years ago, well, 6 or 7 years ago, ever since the 2008 recession, self-employed had seen falling income, no increase in income. And that was mostly down, though not necessarily to the kind of individual earnings, but the changing composition of self-employment. There was a lot more filling in kind of work, people that couldn't find themselves jobs and tried therefore to earn money for themselves. The number of self-employed is really high. The time there we have 4.6 million. We'll update that figure in a little bit. And that was quite a lot more than the pre-recession figure. So that increase in self-employment, but a decrease in earnings because a lot of the new self-employed were not, frankly, making much money. In fact, the increase in employment over that period was pretty much half self-employment, which again is a really good indicator of the number of people that went into self-employment for various reasons. And particularly the lower earning self-employed, people that might be expected to have needed in-work support, in-work benefits, and so on. Going back to the labour market figure in June 2016, we had almost 15% of all the people in work were self-employed. And on average, they earned less than other workers. Going back again 10 years, but still useful here. The average median income for all people in self-employment was around about £11,000. And again, average income fell by almost a quarter over the 4 years following the recession. The number of women in self-employment increased faster than the number of men, but they earned a lot less, barely over half as much as the typical self-employed man. Some of the reasoning behind that, because they tended to work fewer hours because they were self-employing a lot around childcare requirements and so forth. And of course, that included having to be able to cover themselves, if you like, over school holidays and so on. One of the advantages of self-employment for many people is the flexibility that you get from it in terms of when you work and how long you work. A little bit about the figures, again, covering sort of period up to 2016, and see the way in which the numbers of self-employed went up, but went up substantially more for women than for men. The difference in ages is also really kind of quite interesting. You can see again over the same period here, the self-employment of people over pension age was shooting up. reflective of the financial issues for pensioners, but also reflective of the fact that people wanted to go working. There are the, if you like, the higher paid self-employed who may go into consultancy after perhaps retirement. Um, but we also saw the increase in younger people going self-employed, the 16 to 24 age group. And as the report there from the Labour Force survey talked about, significant amount of the increase came from people you wouldn't expect necessarily to be working a lot. Then, of course, we hit the issue around what happened during COVID. And COVID was very interesting, quite illustrative in some areas around self-employment. Big falls from the peak of 5 million at the end of 2019 down to 4.2 million in early 2022. And that was driven, so the statistics tell us, by people who were leaving self-employment to become employees, which seems to be interesting, where they're finding themselves new jobs as well, but not actually. What was happening was that there were many people who were in the same job, doing the same work, but they reclassified themselves as employees, coinciding with the furlough schemes that were available at that time to subsidize companies who had employees. And these people were mostly found amongst the high skilled. So the suspicion there quite clearly is people were taking advantage of a scheme that offered support for employees by reclassifying themselves as employees within their own company, if you like, and claiming help from the furlough schemes. So we saw a 30% fall in managerial director and senior roles there. And very many of those people were now suddenly becoming employees who were unable to work and therefore getting the furlough subsidy provided for them. So because of that, we ended up with 500,000 fewer self-employed people at the beginning of 2022 compared with the beginning of 2020. And the expectation might be that post the furlough schemes, many of those will return into self-employment. Oddly enough, Wales was a kind of an outlier in some of these things. The self-employment fell across everywhere in the UK, apart from Wales, where it appeared to increase slightly. I haven't found any reasoning behind that. Although it's also true that within Wales, the proportion of self-employed who fall into those high skilled categories is lower. So looking at the recent kind of figures around how many people are self-employed, we saw that kind of continuing increase from 2017 up to 2019 when the COVID bit fell. Then that huge drop, largely explained by people taking advantage of those kind of schemes, and then beginning to climb again up until the beginning of this year when the latest figures are there. In terms of how much the self-employed earn, it's actually very difficult to find out in some ways. What we do know, and what's quite clear, is that self-employed earnings have been falling in terms of the median earnings there, and that self-employed people earn substantially less than employed people of the same sex there. So you can see there the blue lines for employed men and self-employed men, and the brown or orange lines for self-employed women and employed women. Again, this is running up to the 2016 report figure, where we were seeing, of course, post-recession and the early 2010s reductions in income very widely. So, how much are people earning this year? Well, I just went around and I Googled for self employed average earnings and came up with some very interesting figures. Most of these are from kind of employment agency, work finding websites. So, PayScale says it's 32,000 a year, Talent says it's 42,000 a year, Total Jobs says it's 36,000 a year. Glassdoor says it's 42,400 a year. So we're getting some really quite kind of high figures and very variable kind of figures. So there's no justification on any of the sites for how they've arrived at these things. The London figure, as you might expect from one focusing on that area, again higher still. When you actually start looking at websites that provide some justification for the figures that they come up with, and those are typically around people looking around sort of accountancy and tax sites, you get a very different kind of figure. Simple Tax estimated that men's annual income is about 18,000 and women about 12,000. So 360 a week, £243 a week. So I think we can probably safely assume that those employment and work finding websites are being a little bit unrealistic in what they claim average self-employed earnings to be. Going back to that 2016 report, where you can see the median figures for self-employed versus employees there, and the difference in terms of the fall in real incomes in estimated annual earnings, where in 2007 £14,000 falling to £10,000 by 2013. One word of kind of warning there, quite a lot of that is explained by a largish number of very low earning people entering into self-employment. Because the median figures, so half the people will have earned more than that, but half the people will have earned less than that. So if you assume that half the self-employed people in 2013 and 14 were earning less than £10,000 a year, you can get a picture of the kind of level of self-employment earnings that many people have to work with. And that, of course, brings us on then to look at the issues around self-employment and financial help. All governments for decades have recognized that people who are in work, employed, working full time, may very well find themselves in jobs that just don't pay enough to meet their needs. From the purposes of employers, that they understandably want to pay somebody for what the value of the job is to them. They are not going to want to pay somebody on the basis of what the employee needs. You can't expect a firm to sort of work on the basis of paying somebody doing the job a certain amount and then paying the other person doing exactly the same job less because their needs are lower or more because their needs are higher. So when you're looking at in-work support, then from the point of view of the government recognizing that if you want people to be able to afford to carry on working in terms of low paid employment, you're going to have to top it up to help them meet their needs. The alternative, of course, is for people not to be able to afford to work and to depend entirely upon the state. And there's always been an argument around the fact that what in practice might be happening is that the state is subsidizing poor employers who pay unrealistically low wages, and that's one of the arguments behind having a national living wage. But for the purposes of the self-employed, it also becomes really quite interesting, because from the viewpoint of the legacy benefits, there was very little difference between the treatment of people in self-employment and the treatment of employees once you'd arrived at an earnings figure. You could then go on and look at whether they needed in-work support and how much that would be. With universal credit, though, things have changed and changed pretty substantially. Universal credit and self-employment is an entirely new kind of creature. And from the purposes of the self-employed, or from the viewpoint of the self-employed, it is incredibly complicated and really, really quite difficult. So we have, again, lower earning self-employed people, putting to one side the high earning consultants kind of group, who skew the averages of earnings quite a lot. But from the point of view of lower earning self-employed people who need some extra support, well, the I can't spell rules. You know, as universal credit finishes kind of rolling out, people will find that the new system is very different and very much more complex than the tax credit system that people have been depending upon before. And it's really important that people recognize those differences, and especially so where people are thinking about becoming self-employed. It's very different in a number of ways. In working tax credit, still many people on working tax credit because the universal credit has not yet rolled out. It's just beginning to arrive in Wales in terms of what's called the managed migration. People have been moving on to universal credit as their circumstances change, or where they're making a claim for the first time now for a few years. But only now are we beginning to see people being taken off the existing benefits when their circumstances haven't changed, and not actually moved onto universal credit, but told that if they want to continue receiving support, they must claim universal credit. Tax credits were relatively simple for self-employed people because they were delivered by HMRC and they were aligned very closely with the tax system. They were based on an annual earnings figure in the same way that tax was. They were using the same effective tax rules to determine, you know, how the earnings were treated and so forth. And that tended to mean that even, you know, fairly low earning self-employed people who needed to have their tax and their working tax credit sorted out could go to the same high street accountant and get them to do their annual forms for both and put in all the receipts which were common to both of them. In universal credit, it's not like that. Universal credit, self-employed people have to put in effectively their accounts to DWP every month, based upon you know, their cash in on the cash flow and the cash out. So much more frequent reporting, and of course not a thing that you can afford to pay an accountant to do on a monthly basis, particularly because the figures are no longer aligned so closely with the tax system. There are differences in the way that losses can be offset against income. It used to be pretty much direct. Now there are some very special rules about it. The allowable expenses for self-employment are now much lower than they used to be. In the tax credit system, you could, for example, have a reasonable claim for low-cost entertainment. No kind of equivalent to that in the current system. The same goes for a lot of the other expenses factors. And it is an extremely complicated calculation. If you're trying to work out how much help you're going to get, for self-employed people, it's really, really difficult. It's on a monthly income in, income out basis, and that includes all sorts of things like VAT and income tax and national insurance. The month in which you pay them is the month in which they count towards the calculation. So these kind of big lump sums get skewed across the year rather than being spread evenly, as was the case with the legacy benefits. Really, really hitting people is what's called a minimum income floor, the MIF. And that's a notional earnings figure that's used in place of what the real income is. What the MIF rule says is that once somebody has been working with a business for more than 12 months, they will be expected as a minimum to earn, for most people, 35 times the national living wage every week. There are a couple of differences where you have things like childcare responsibilities that can be lower than 35-hour figure. It can drop down to something like 24. But for most people, they would be expected to earn 35 times the national living wage. If they earn more, then the higher figure is used in the benefit calculation. But if they earn less, then that 35 times the national living wage figure is used to calculate their entitlement to benefits. And if you earn quite a lot less, it's still 35 times the national living wage that's used. So the basis of the in-work benefit support is no longer around how much do you actually earn. It's around you're going to be expected to at least earn national living wage or more. And if you don't, well, we're going to calculate it as if you do. That's a really, really harsh bit of work there. There is some limited provision if you actually have a real loss during the course of a month. Fairly limited, but you can carry a loss forward a little way, but you can't obviously carry forward a zero earnings figure or anything between that and national living wage. There's the complicated basis of universal credit itself anyway, which is complex for everybody, whether they're employed or self-employed or not working. The overall benefits cap that limits the total amount of help you can get from the benefit system, again, comes into play here. And if you actually have a really good month and you earn quite a lot of money, well, there's a calculation that says, well, some of that is going to be used as income in the following months. So it's a kind of reverse minimum income floor where you get penalized for earning too little, and there's a kind of a penalty for earning too much as well. There's no offset around that. Self-employed has always worked on the basis of how much profit do you make, your income over your expenses. And that's still kind of the case within the universal credit system. So it's the actual receipts, the actual money you get in, minus your permitted expenses, and then whatever you are paying out in terms of those expenses is not, again, as simple as it might be. But it does include these kind of national insurance contributions. It does include VAT, but it includes them in the month that they're made or received. So a lot of these things might be 3 monthly or 6 monthly. And rather than spreading them over the course of a year, which the tax credit system would have done, we get these almost artificial peaks of expenditure and these artificial peaks, I suppose, of income as well, but in some cases. And that has a real impact, because if you happen to have things that are coincidentally a good month with no expenses, then you might hit that surplus figure that's used later on, or a bad month with piles of expenses, then you'll have nothing left. There's nothing there to offset those expenses against. You're just going to be treated as still having the national living wage level of income. So if there is some flexibility around when you make and receive payments and you're self-employed, it can be really, really useful for you to say, well, okay, frankly, don't pay me that bill this month. Pay me next month, because that's when I've got to pay my income tax, or that's when I've got to pay my VAT. And it's an awful lot better for me to be able to offset those against real income than have to make those payments when there's no income to offset them against. So there's some really complicated planning that people could do. And if they did that, then they might very well find themselves in a better position financially than if they just do things on the date that things are due to be made or to be received. And again, if you're making the kind of the big payments in a bad month, well, pick a bad month when it's going to turn therefore into a loss, because you can bank that kind of loss a little bit and offset it against some later dates. General difficulties, well, so many of them. The monthly accounts bit is actually asking a lot of quite a lot of self-employed people, particularly the lower earners who are not necessarily used to handling accounts, to handling kind of mathematical calculations and so forth. Previously, the annual once a year accountancy bit took a lot of pressure off people, but having to do it monthly really puts pressure on people. And it's also pressure from a time. You have to do it by a particular date, or penalties can apply. It all leads to uncertainty about the benefit amounts you're going to get each month. Because it's a month by month calculation, again, it doesn't spread things over the year and give you an even level of benefit support over that year. You get very big peaks and very big troughs, even when you might have very standard kinds of earnings. When you don't have very standard kind of patterns of earnings, things become even worse. And if you have those uneven earnings, the classic example is somebody with like the Christmas tree farmer. You can end up in a situation where for 11 months of the year you have no income, but you're treated as if you've got 35 times the national living wage in terms of a calculation. And then you have a bumper month in December. And what happens then, of course, is you're found to have no entitlement to benefit at all in that month. You may, in fact, then create a surplus income, which is used then to reduce your benefits again in the following months. Same goes on perhaps on a lower scale for people who have very seasonal patterns of earnings, or who just have earnings where they're doing bundles of work and getting paid every few months for what they're doing as their piece of work completes. And all of that affects the amount of benefit you get, and that affects the ability you have to plan and to budget. Similarly, if you have uneven expenses, if you have these 6 monthly VAT bills, you have these tax bills or other bills every 3 months, you have to buy your supplies because that's the season of the agricultural produce or something. All of these affect again the way in which the benefits will be very variable from a month-to-month basis. Gainful self-employment. If you're going to be getting help from the Universal Credit as a self-employed person, one of the things you have to prove is that you're gainfully self-employed. And there are a number of questions that have to be asked and proven about that. Are you carrying on your activity as your main employment? Are the earnings self-employed earnings from it? Is it organized, developed, regular, and carried on in expectation of profit? These kind of tests that are applied to decide whether you are actually self-employed. And it's quite possible for the DWP to decide that you have earnings from self-employment, but you are not gainfully self-employed. And in that case, then all the rules around work conditionality, about attending interviews, about applying for other kinds of jobs will be applied to you, and your earnings will be taken into account as if they are employed earnings. The minimum income floor itself, as you said, most people expected to work 35 hours a week at national living wage, so that generates the figure that the MIF is going to be there for. If you're in gainful self-employment, I'll put this in rather lump. and you have some uh, income which is lower than that, together with any employed earnings lower than that threshold, 35 hours a week, then you're treated as having that MIF as an earned income figure. And that's what's used when you calculate the universal credit. These slides and the recording of the webinar will be up on the Dangos forum later today. The MIF doesn't apply to you if you're starting a new business. You've got 12 months when that doesn't apply to get the business going. So if it actually takes longer than 12 months to become profitable, then the MIF can make things really, really difficult. And you can have this 12 months once every 5 years if you're starting another business because the first one has failed. There can be a deduction of a notional amount of tax and national insurance each month arriving at the MIF, which in itself is an interesting calculation. We produce a reckoner which can help with that. Doesn't take account of pension contributions. If you're earning above the MIF level, then you can offset your pension contributions. And of course, if you're an employed worker, an employed earner, then the whole of your pension contributions are ignored when working out the level of your earned income. So again, there's another bit of a hit on self-employed people who aren't encouraged to increase their pension savings. Talked a little bit about seasonality and variability. So you get a very, very different level of entitlement frequently to that you would have got on an averaged annual basis if they followed the same kind of pattern that the legacy benefits do. And this imprecision around the pattern of making your pension contributions, the tax payments, the VAT payments, and so forth. Understanding the way in which when you get money in and when you pay money out can make a very big difference to the amount of benefit that you receive. So, a little bit like proper tax planning for the better off, proper benefits planning in terms not of trying anything at all, any fraudulent, but just knowing when is the most effective time to receive money if it's flexible, and when is the most effective time to pay money out if it's flexible, can make a really, really big difference to you. As I said, it's very unlikely you're going to be able to afford to find even an accountant willing to be used on a monthly basis. And of course, it's the people with low levels of self-employed earnings who would be least able to afford to pay those people to do that bit of work. And it wouldn't be an allowable expense under universal credit rules. Passporting has been important for decades. This way in which means tested benefits in particular are used as a proxy by a lot of other schemes, where somebody's offering some help to people but says we want to target it, we want it to be only given to people who are really in financial need. So we could run our own means test, and maybe we do, but it would be a lot easier if we had a way of identifying people who were in need on low incomes. And what people very, very often do with many schemes is to say, well, look, if you're getting a means tested benefit, then you're clearly in need, and therefore we can tick the box and say, we don't need to do another test, you'll just qualify for the help that we can give. Increasingly, universal credit is one of the passported means tested benefits. But universal credit is not just a benefit for poor people, unemployed people, people in that kind of level of need. It's also a benefit for people who are in work. And so increasingly we're seeing that this passporting comes with caveats. It's saying, well, okay, we'll give you help if you're on universal credit, but only if you earn less than the particular amount of money. And there's some quite variable differences in the amounts that schemes use. So these threshold amounts, again, just complicate things in terms of you can't say to somebody anymore, well, yes, you'll get free optical and dental treatment if you're getting a means tested benefit. That's still true of people getting pension credit or job seekers allowance, but it's not necessarily true for people getting universal credit. Because of that variability of the amounts of benefit you might get, then 1 month you might qualify because your earnings are below a certain amount, but the next month they might be above that limit and you won't qualify. And how often have you got to reclaim and tick the right box? You might even be ticking the box thinking that that month you're qualified, when in actual fact it'll later on turn out that you're not qualified. And there have been some quite big problems around things like NHS benefits where the forms didn't ask the right questions and the scheme didn't necessarily have the right rules to cater for people on the universal credit, whether employed or self-employed. But of course, employed people are much more likely to be on a very much more level amount of benefit month by month and a very much more level amount of earnings month by month. Difficulties for the other bodies, the ones that are using these proxy tests for kind of low incomes. Free school meals is a good example there. Free school meals tend to be worked out on a term basis. So if you qualify, you get your free school meals for that term. But within universal credit, you might have 1 month in that term when you qualify, and another month in that term when you don't qualify. What happens then, and how does it work retrospectively? You can't take the food back out of the children's stomach after you found out that there wasn't a qualification. Some really, really big practical issues that follow on from this. And again, because of that variability around self-employment, particularly difficult there. And it's administratively onerous in all sorts of ways. So if you want to qualify for the extra, the optical and dental treatment, to travel to hospital and so forth with the NHS schemes in Wales, well, you see if you get universal credit and you had an earned income of less than £435 in your last UC assessment period, then you might qualify. Or if you get a child element and somebody had a disability test, still taking great level of time to get through those tests and to have them actually carried out for universal credit, and then you had a higher level of £935 or less in the last, you're expecting two lots of people, the claimant and the administrative body, to do an awful lot of work around something that might change very, very frequently, rather than creating, as they did in the past, a little tick box that said, well, if you get working tax credit, then fine, you're also counting as getting a means tested benefit and you'll qualify for this help automatically. That whole pattern of higher and lower, of course, applies to people who might actually just not qualify in 1 month for universal credit because their income has gone too high for that one period. When you don't qualify for universal credit in a month, that's it, you're off the benefit. You have to then actually reclaim the benefit in the following month. You think you're going to be entitled to it then. There is a rapid reclaim process, but it's still a process that you have to remember to go through. You have to know to go through. And there is kind of effort involved in doing that one. So again, this variability hitting particularly self-employed people. The high earnings in a month taking you out and having all the impact of surplus earnings, the low earnings in a month, meaning you've got to have less money from earnings, but it's not made up by universal credit because of the minimum income floor rules. Gets quite wearing. Older people, self-employed older people, we saw on that chart earlier the number of people over 65 shooting up there. The bulk of self-employed people do fall within working age, but there are a substantial number who are working above retirement age. And of course, if you're working above retirement age, you've got to recognise that that's it. You have lost any access to in-work support. You used to be able to, in some ways, still make use of the tax credit system if you were older and self-employed, but you can't get access to universal credit if you're over pension age there. So you're losing your access to in-work support. And you also don't have any allowances against your earnings. So universal credit has work allowances for some people, a chunk of earnings that isn't taken into account. It has a taper so that you get to keep just over a third of your earnings anyway, even though the rest of it is taken off your benefit. For pension credit, all taken off your benefit after it's net of tax and national insurance and so forth again there. So quite difficult for self-employed people who are trying to earn a little bit more. If there's any pension credit entitlement, they've got to earn probably quite a lot more before they wipe out the pension credit and start making any real gain from their self-employment. And yet, there's still doubled those number of over 65 self-employed, 500,000 of them now in the last 5 years. A little bit of an advert, I'm afraid. There's a lot of these things that you've seen are quite complicated and difficult. And we have produced some we call reckoners to try and help people to work things out. So there's self-employed expenses. There's a calculator there that works those out for people. The minimum income floor reckoner will tell people how much the minimum income floor should be for them. The way in which losses can be carried forward, we have a calculator for those, and also a calculator around the surplus earnings rules. And those are all on webreckoners.com. Some of them are free, some of them are chargeable, but for an individual, it's £12 a year or something. And if you're an advice agency or an organisation, it's only, I think, about £25 or £30 per office address for access to all of the reckoners. There are lots of different ones as well there. I said a little bit about the fact that we're coming on to the time when people are going to be moved on to tax credits. The first group of people being moved, from tax credits, first people being moved in Wales, coming in, I think, in September. Where parts of southwest Wales will see people getting these letters saying, look, we're going to be stopping your existing benefits soon. If you want to get any help, then you need to apply for universal credit, and you've got a time slot of about 3 months to do that in. Choosing when to do that is really, really important. There is what's called transitional protection. And what that's saying is that, look, when we calculate your universal credit, we have a kind of an interim of what we think you're going to get. We will look at what you were getting from legacy benefits and say, well, look, if our figure is lower than you were getting before, we'll top it up. It's a cash top up. It doesn't increase in future years, and it's quite easily eroded away. But nonetheless, it is there, and it's there for people who are self-employed as well as people who are in work or not working. But of course, because of that variability again for self-employed work, then the date on which you do that could make a very big difference. I suppose from the purposes of transitional protection, ideally you want to pick a date when your universal credit entitlement will be as low as possible and your kind of tax credits or other benefits figure as high as possible, so that you can maximize the transitional protection. But knowing when that date is, again, very difficult to work out, and very difficult to find advice about that. It's complicated for everybody, for those of us kind of in the advice world, and for everybody else. But it is still an important one. We're working on trying to produce the transitional protection calculator. But at the moment, there are some real issues around how transitional protection itself is calculated, and even DWP seem to be unsure about that. Uh, Again, the transition protection, as I said, gets eroded away. And it's more easily lost when you have a potentially large income variation than when you've got a standard ongoing month by month kind of income there. Um, and there may be a very big difference between tax credits and universal credit, in particular because tax credit um, treats capital and savings very differently. There's no capital. A kind of tariff income calculation. There's a calculation around um, the actual earnings from your capital. And of course, there's no capital cut off in this in the same way either. So that's going to be a very big shock for people who have perhaps more than £16,000 in capital. There will be still some transitional entitlement for a year for those people, but very easily lost. Briefly looking at other sorts of financial help, there aren't very many schemes in Wales that differentiate between self-employed and employed claims. But where the universal credit is that gateway into help, then that can make things more difficult because of those kind of issues around things like earnings thresholds and so forth. Council tax reduction, passported by legacy benefits in the main, but where universal credit comes into play, then first of all, it has to use the universal credit income calculations for doing its sums, and it has to take universal credit into account as income when doing the sums again, so it hits people a bit more there. Comments and questions. I will have a go now at undoing getting all the unmuting and so forth. But very briefly, give you another quick bit of an advert for new Dangos sessions that have just launched in the last week. In fact, bookable now. We have a session on older people and their money, looking at pensions and pension credit and other kinds of help there, and one on children and young people, taking people through from help and support in pregnancy up to the time that they kind of for adulthood. October, we've got help for those in need of care, looking at disability benefits and looking at things like social care charging and the different types of social care that's available. And of course, our basic and intermediate courses are still in full flow. And I'll get on to unmuting now. Just a quick reminder that the next webinar is going to be 28th of September, and that's going to be looking at older people and their money. So let me see now if I can unmute people. I think you should be able to unmute yourself. Ellen actually you've got your hand up, so that's great. Do you want to try unmuting and asking the question?
Yeah, I think I've unmuted. I just wanted to ask, are there any concessions for people with regard to the minimum income floor when they're in receipt of PIP?
Yeah, well, good question, because there's a big change coming in terms of the way in which disability needs are assessed for universal credit. At the moment, they introduced the equivalent of a kind of a work capability assessment, where people have to go through an assessment to see whether they have a limited capacity for work and for work-related activity. And if they do, they get put in a different universal credit category. And they actually, I have to say, I'm not sure about the myth, but some of the thresholds and the benefit cap don't apply to them. Well, DWP have said that they're getting rid of the work capability assessment for universal credit, and they're going to use PIP instead as the qualifier for people coming into that in the future. So that will mean, therefore, that those kind of automatic thresholds don't actually apply. And I'm racking my brain to think about whether MIF and work capability assessments have any relationship. I'll do a very quick Google while thinking about anybody else who wants to ask any questions.
Because well, the issue that I've got is that I've got a gentleman that's got multiple sclerosis. So his ability to work is quite variable in terms of, when he's having a good month, then there's no problem whatsoever. And his with the work capability, he was advised, well, actually, you need to submit fit notes. However, in doing that, then that compromised his insurance, so he couldn't do that. So that process didn't support him whatsoever.
Right, I can see that. And let me just look to the side screen a second. I mean, I know that people who are looking after children under 3 are kind of aren't placed in the all work-related activity group, and therefore don't get hit by MIF. So I'm assuming that people with that kind of level of disability would not be put in the all work conditionality group, and therefore MIF should not apply to them. But I'm just trying to
Yeah, I
confirm.
mean, he's tried through the job centre, and there's nothing they can do to support him unless he's happy to put in fit notes.
I suppose that's probably the only way you can prove that, isn't it? Because as I say,
Mm,
PIP is not a qualifying condition at the moment.
yeah, but
But
you say that
putting
might come in. That might
well,
come
that
in soon.
that is
Yeah,
coming in, but we haven't got a date
brilliant.
for it yet.
Okay. Oh, that's good
But
news.
certainly, otherwise, yet in order to prove that you shouldn't have the work conditionality applied to you, then yes, a fit note would be one of
Yeah, absolutely.
um,
Yeah,
the thing for it.
yeah. Thank you.